You are listening to Angel Insights, brought to you by SyndicateRoom. This is the show where we deep dive on all things angel investing to discover their tactics, tips and strategies on investing in the best startups. And it's a huge pleasure for me to welcome James Routledge to the show today. Where do I start with James? He is most definitely a founder at heart, having founded MatchChat and Seedcamp incubated NowNative. However, he has made the move into the investing world and is now partner at one of the UK's largest AngelList syndicates, the famous Doug Scott's Potential Syndicate, who invest in extremely early stage companies with phenomenal teams. And in the episode we discuss their investing thesis, their due diligence process, why startups now need 2 rounds of funding before they reach the institutional stage, and much more. So without further ado, it's with great pleasure that I welcome James Routledge, partner at Potential VC, to the show. James, welcome to Angel Insights. Thank you so much for joining us today.
Thanks for having me.
Now, can you start us off by giving us a little background about you and telling us how you made your entry into the investing world?
Yes, I can do. So the short story is I started a business with some friends in my second year at the university in Sheffield. Basically, we ended up dropping out in our second year. Initially, we took a placement year, and we went on to an accelerator program up in Newcastle called Ignite 100, run by Paul Smith. Mm-hmm. And over the course of that 3 years, we raised about $1 million in venture capital. We built the business to a relative scale. 130 websites were using our products. We were reaching around sort of 50 million people a month across that network. And in the sort of last 6 months, that's sort of come to an end. That's not sort of public yet, so I can't sort of touch on that. But during that, I'd met Doug Scott, who I now work for, and I think during my time, very much entrenched into startup world, I'd seen the good and bad of seed investing. Mm-hmm. So, and Doug was someone that I'd known quite well, and he'd invested a lot in a lot of my friends, and I'd always liked the way that he backed teams. And at the time, he was setting up his syndicate, so he asked me if I wanted to get involved, and I said yes. So it was sort of a logical and interesting next step for me.
And what was it that attracted you then to the investing world?
I think for me, it's because I'd seen, I went straight from university into startup world, and in startup world, people just talk about raising money all the time, basically. So almost raising money was the only thing that I ever knew. Sadly, I think in some cases, because it's so prevalent. It's the number one topic of conversation, which I think is a bad thing actually. And so because I'd seen great people get backed by bad money and the wrong investors. I'd seen people who I didn't think were great founders actually raise great VC rounds. So sort of wanted to almost see if I could sort of right some wrongs and back people in the right way with the right seed capital. So in that sense, I almost felt like I was on a little bit of a mission to do that.
And how important and how much of an effect do you think your experience in operations has had on your entry into investing in terms of kind of how you look at startups?
Oh, massively. I mean, it's the main thing I draw on, basically, is my experience. I think currently I'm looking, I'm speaking to founders and I'm looking at them just thinking I was where you were, 18 months ago. And I'm sort of seeing myself there, and I think first and foremost, I sympathise with them because I know what they're going through, and I know how gut wrenching it can be, and how their heart and soul they're putting into their business. So I can see that maybe the mistakes that they're making, and I can't tell them what's going to happen, but I can tell them what happened to me, and I'd like to think that's very valuable.
And what's the hardest things that they face, do you think, and what are the biggest mistakes that they make that you've come across?
It's a difficult question. I think one of the big mistakes I'm seeing currently that I keep ranting about is that I think because it's fairly easy in the UK especially, well everywhere actually, to raise a seed round, mm-hmm. I think that a lot of people are raising seed rounds basically for lack of a better idea. I think people just raise money because they can. I meet lots of startups and they have the number £150,000 on the end of their deck, And I asked them why it's there, and let's be honest, it's there because that's the amount of money you can raise under SEIS. So I think people are raising money just because it's easy, not necessarily because they need to. And you can massively tell the difference between a founder who is raising money to give themselves more time and to give themselves maybe even a safety net, as opposed to that founder who's raising money because they want to achieve X, Y, and Z in 12 months. There's a massive difference.
And we've seen the rise of 2 seed rounds now, it seems, kind of a seed and then some people call it a bridge or a pre-Series A or whatever you want to call it. What do you make of that? I mean, have you seen that a lot in your sector? And why do you think that is?
Absolutely. It's something that I've written about a lot, actually. And unfortunately, even though people know it's there, I don't think anyone prevents for it. So you'll have people raising seed rounds at valuations, initial seed rounds, at valuations that aren't taking into account the need for that second seed round. So when it comes to that second seed round, pricing it is almost impossible because people know that a Series A could be coming, and it's going to really hurt the founders. I think the reason it's there is because it's hard to raise a proper Series A or institutional round of VC funding. In terms of a benchmark, the number of companies getting funded at Series A hasn't necessarily changed, whereas the number of companies getting funded at seed has massively. So the bar has gotten higher. So the milestones needed to raise a Series A round from a VC are greater now. So it takes more time. I think someone told me the other day, I don't know if he plucked this number from the air, but he reckoned that it was around £850,000 to get to an institutional VC round now, like a Series A.
And do you like to engage in that pre-seed bridge round, or do you very much focus on the very earliest stage?
So we're usually much earlier than that. So typically we like to be first money in the deal, but then the sort of second half of our model, which is sort of what we're touching on now, especially now there's funds that have come onto AngelList, is potentially those later seed rounds where there's a bit more signal from the market, and we can syndicate those rounds. But ideally, we would be very, very early.
And talk to me about the syndicate. I mean, how does it run? What are the preferred sectors? Do you have any kind of geographic locations that you hone in on? Give us a background.
So UK currently. Sector agnostic. I mean, we're not focused on any given sector. I think we have a lean towards consumer, but not a focus on consumer. That lean is probably just there because of the legacy of Potential and sort of what we're good at. In terms of the syndicate and how we work, we've basically got 2 types of companies which we invest in. One, as I just mentioned, is the really early company. So typically we'd be the first money into the deal. We would have about £100,000 to £150,000 allocation, and we'll help the startup raise that round of funding by bringing in angels and obviously leveraging our syndicates. And then we will go on to help them raise their following rounds of funding, with our sort of ultimate goal there is basically to pass them up the food chain and help them raise a good VC round. And then more and more now, I think we're starting to see that AngelList as a platform and syndicates in general probably work a little bit better when there is more external signal from the market. So in the sense that there's potentially a reputable lead VC, there's slightly more traction, there's maybe some other well-known angels in there, and that helps people who are basically making a decision online on the platform. It helps them make the decision more easily, and also it helps us attract the attention of the funds that invest via AngelList.
And as a syndicate then, what does your deal sourcing really look like? I mean, at such an early stage, how do you hunt the best deals and entrepreneurs?
So for us, I'd like to think that we do a good job of marketing ourselves online. I'm sure a lot of people reading this have maybe been retargeted by an ad with their face with a bandana on, so I think we're quite good at getting our name and our brand out there. So,
and a must for everyone, I've got to give a shout out, is Doug Scott's newsletter. It's an absolute must read, and we'll include links in the show notes for you to sign up to that.
Oh, well, thanks for that. So I think we're good at that, and as a result of that, we get good sort of inbound deal flow. We get startups reaching out to us directly. we get good introductions from our network, because I'd like to think that we're sort of potentially front of mind for early deals. And then when you're investing at the stage we are, obviously the most important thing is the founding team. So we like to get to know the founding team as early as we possibly can. And in that vein of thought, accelerator programs are great for us because it means that we can get to know a team when they're literally at this sort of inception stage all the way through to the next 3 months, when hopefully they've got a working product and they're starting to see some sort of adoption. That means we can really get to see a founding team grow and watch their progress. So accelerator programs are a good source of deal flow for us.
Will you invest in the accelerator companies before they're actually in the accelerator?
We've not done that yet, but
at what time is it optimal to make the investment then in the accelerator companies? Is it on the demo days?
I think a lot of the time we've made the decision before the demo day. I mean, and I think that's a pretty fair comment for every investor out there. I don't think many investors have made their decisions as a result of a pitch. Yeah. So most of the time the demo day is basically a networking event and a chance for the accelerator itself to show off, and rightly so. But a lot of the time deals are already done before demo day.
And then once you've found startups, say not, or it could be in a accelerator program, but just generally, what are the KPIs that you then deep dive on? I mean, what metrics really get you excited and think that it's an investable opportunity? Well,
at the really early stages, there's usually very little metrics. So first and foremost, it's more sort of qualitative than quantitative, I suppose. So it's more about the character traits of the founders, I think. So we're really looking to get to know the founding team quite well. We're looking for tenacity, perseverance, drive, hunger. That's 90% of our due diligence. Founders who really know what they want and almost look like they're willing to sort of smash through a brick wall to get there. And then obviously, secondly, we want to see product live, and we want to see some signs of adoption and some numbers going in the right direction.
And what's the right direction in numbers then? Is that kind of, I don't know, obviously YC have a 10% week-on-week growth requirement. That's pretty heavy. What kind of numbers do you look for?
I wouldn't say we've got any benchmarks. Every business is different. We're really just looking for early signs that people genuinely care about what that team are building. People are using it. They don't have to be paying for it, but are there active users? Are they engaged? Are those numbers going up week on week or month on month? We're just really looking for early signs of adoption, and that people actually care about what's being built. And I don't think there's any excuse to not have some traction, really, or even if it's bad numbers. Every startup can get a product out there and test it, I think.
Is there anything that puts you off in founders? You said you love the tenacity, determination, passion. Is there anything that you don't like to see?
When you're investing very early, you're making a decision to work with someone for a very long time. So we genuinely have to like that person. And, there's certain people you just don't get on with, and that's nature. But I really like to see founders when they're potentially in different social situations. So a lot of the time, we'll go out for dinner with them, we'll take them for drinks, and I really love looking for little things like, is the person polite towards the waitress? Do they say thank you? Just things like that really sort of interest me. Are those sort of character traits? What are they like in other situations? I think that's quite interesting. In general, even if someone had an unbelievable business, we would never work with someone who we just didn't like as a person, because I think life's too short in general, to be honest.
Absolutely. And talking about great founders there, as the syndicate, you lead the investment. So what do you think makes a great investment lead then? So
the lead's going to do a lot of work, and that lead is going to do a lot of work for relatively zero immediate reward. In fact, they're probably going to spend a lot of money and a lot of time helping that company for next to nothing. A great syndicate lead needs to be someone who genuinely cares about that business and that founding team and what they're trying to achieve. Because if they don't genuinely care, they're not going to put the time and effort in required to help that company raise a great round of funding. Mm-hmm. So that's why I think that relationship is so important, because the syndicate lead's going to have to work really, really closely with the founding team in the early stage of putting their funding round together.
And then talking of kind of collaborative investing with the syndicate model, what do you believe are the benefits of this kind of investing collaboration?
Obviously, you get to draw on different resource. So, two heads are better than one if you're co-investing with someone else. There's different networks to tap into. There's different advice, more capital. So, yeah, lots of benefits.
Are there any challenges then? Are two heads ever too many, or might be 20 separate investors? Does that ever cause conflict? What are the challenges?
I think the biggest challenge is the initial challenge of finding co-investors who sort of have the same philosophy and share the same beliefs, mm-hmm. and who back founders in the same way. Because I think there's potentially times when, as an investor, I think we're fairly relaxed. We will back the founder. We don't ask for any sort of strenuous reporting, or we don't ask for board seats. And that's how we back founders. That's just our style. Now, if a co-investor alongside us was the complete opposite to that, then there's almost a bit of a conflict there. Mm-hmm. So I think you've got to really find co-investors who think, as an investor, who think the same way as you. Mm-hmm. And then obviously you have the logistical challenges of time, legals, lots of spinning plates, managing a lot of moving parts at the same time. But I think the first and foremost, it's around shared values.
And we talked earlier about kind of pushing startups through the value chain, and obviously at the higher end of that, syndicates and angels have to work with VCs to kind of encourage further development in the ecosystem. So how do you establish relationships with the VCs? How important is that for you as a syndicate? And is it crucial for angels too?
I think I'd go as far as to say it's fundamental for both angels and VCs. Okay. At the end of the day, angels are typically going to invest far earlier than any VC ever would. Their relationship is going to be much more intimate with founders, because they're potentially operators and entrepreneurs. So they've got a massive value add in the life cycle of a startup. But for an angel, if they want that company or their startups or the startups in their portfolio to go on and to be a big success, at some point they're going to probably need to raise VC funding. So the angel will need to essentially pass their portfolio up the food chain. Mm-hmm. So for angels, relationship with VCs is extremely important. And then for VCs, they're obviously going to want to get to know who the angels are that they like, who they like working with, who thinks in the same way as they do, because that's going to be their deal flow.
And if it's okay with you, we're going to move into a quick fire round now.
Yeah, cool.
So your favourite blog or newsletter?
Pretty boring. Well, not boring, it's great, but it's probably the same as what everyone else says. Paul Graham, I love. Fred Wilson, great. And then actually anything that Paul Smith from Ignite writes I think's amazing, because he just sort of says it how it is and doesn't really care what anyone else thinks, which I think's great.
And then if you could give founders one piece of advice, what would it be? Right
now, I would go for don't raise money just because you can.
Okay. And do you believe that startups should be raising a war chest if they can? Is it better to raise for the long term?
If they are absolutely sure that that's the path that they want to go down. I think there's founders and companies raising money when they don't even truly understand the sort of ramifications of what raising money actually means. Mm-hmm. They potentially don't actually know what they want. Do they want to have a big $1 billion business that's VC backed and that's going to have to sell out one day, or do they just want a really satisfying, profitable business that they own 100%? I think the problem is that a lot of people don't know what they want, but they're just raising money, could be because they can.
And then which angels do you most respect and admire?
Well, I'm going to say Doug Scott, of course.
Of course. How could you not?
Tell me off if I didn't. And then, obviously, don't know many angels in the US, but in the UK, currently really like working with guys like Steve Pankhurst, the founder of Friends Reunited, makes decisions really fast, backs teams in the right way. Andrew Weiss, who currently works with Gin, he again works really hard with companies and helps them out a lot. And then, Richard Fern is another guy I think is good.
And then how do you measure your success as a partner at Potential? Is it returns? Is it kind of value add? What is it for you?
Well, ultimately it's going to be returns, of course, but immediately I think it's a helping get founders to the next stage, which is raising a quality institutional VC round.
Mm-hmm. And do you find the really long feedback loop hard, having entered the industry relatively recently?
I mean, we're making our judgments on paper returns at the moment. How many up rounds have there been? So, that is quite infuriating, and it's difficult. But I think you can sense it. I suppose another measure of success would be how many great people have we backed doing what we think are great things, which are genuinely helping the world. And that's a little bit more sort of cheesy, but it's a good measure, I think.
And then finally, your most recent investment and why you said yes.
So I won't say names just in case, but simple, smart team, numbers going the right way.
Well, James, thank you so much for joining us on Stage Show. It was absolutely fantastic to hear your thoughts and the future of Potential.
Thanks very much. Thanks for having me on. It's been a pleasure.
And I would like to say another huge thank you to James for giving up his time today to be on the show. And if you're loving Angel Insights, then please do follow us on Twitter at SyndicateRoom, or head on over to the website at www.syndicateroom.com. And we look so forward to seeing you in the next episode. Thank you so much, as always, for your continued support. We would also like to remind you that early stage investing can be risky, therefore it is important for you to do the proper due diligence prior to making the investments.